With the market and the record close for the S&P and the Nasdaq, joining me now is Citi Director of U.S. Equity Strategy, Drew Pettit, and BD8 Capital Partners CEO, Barbara Duran. Guys, welcome. Drew, stocks at all-time highs. We're expecting a rate cut, maybe several. Can the market still run from here after a rate cut, or is this cut a sign that the economy might be worse than the market has digested?
It's a little bit of an if, John. So to us, we think the economic data actually holds in. So that's positive for stocks. So in that environment, positive economic data, 2-year yields down with the Fed cutting, we actually think the curve steepens. And that actually is not a bad backdrop for growth to keep working, which can drive the market higher. And it's not bad for some mid-cap broadening as well. So to us, yes, but it's all about economic data and if it holds in.
So, Barb, how do you position out there with the labor market weakening, investors coming up on a quarterly road marking pretty soon? Do you rebalance, reposition in a particular way, given the numbers that you're seeing?
Yeah, I think it's a good question because things have changed, but we've started to see the change since Jackson Hole, when Powell signaled that they really were looking more at the labor market, which that's when he indicated that interest rate cut this week, this Wednesday, is likely. And so that's when positioning into more interest rate sensitives. We've talked about that. You stay in the mega cap growth. Those are secular long-term stories that will, I think, continue to outperform given a lot of their double-digit growth. But the banks, which are making new highs, I think you stay long those, although you have to hear what Powell is going to say. If this is going to be a one-time cut, the market right now, I think, is anticipating 3 cuts. It's going to make a difference in terms of the possibility there because they are at new highs. So I think you continue to, small caps, I think, are vulnerable here for separate reasons than interest rate cuts. But I think that's where you have started to position already, but more interest rate sensitives. And that's some consumer discretionary as well.
Drew, is it a concern? This is a very bifurcated economy that we're in right now. Things are great for the market if you own stocks, but if you're a new college grad, if you're anybody who's been out of work for a while, if you're working class, paying rent versus, collecting home equity, this picture looks very different for you. How does Q4 and the way it plays out influence the way we should think about this economy and the market with that backdrop?
So it all comes back to broadening. It's funny, we're talking about how good the markets are. I guess you've made a lot of money if you're in the right stocks and been in the growth names. Value, small cap really haven't participated nearly as much, even though when you look at their valuations, they're not necessarily cheap either. If you get a breakdown in more of the consumer and you don't get a lot more of those value, cyclical, and small cap names showing positive earnings growth, you end up in a more unhealthy bull market, I would say, something that stays narrow again. So if the consumer holds in, if the lower end consumer holds in or reverts, the younger consumer does well, then you start to see more positive contributors to earnings growth. It leads to a healthier bull market.
Barb, finally, how does the China trade news affect your view, not just of the U.S. economy, but the global economy here?
Well, I think the China trade news in terms of the president talking very optimistically, I think for investors and for companies, it signals that the worst truly is behind us, which the market has been assuming that. But there's still be some some loose ends out there like China. So it looks like the peak aggregate rates would be 30%. So companies can start to plan. They can judge what their costs are likely to be. And also for the rest of the world, they can also, because everybody's been affected by this and the alliances that are changing and this kind of thing. So it gives more clarity. Companies, people can plan a little bit better, understanding what the costs can be and how they have to change their cost structure or raise their prices.
Drew, I've got a little bit more time, so I want to ask you about the broader global economic picture as well. I mean, we've been talking a little bit before about how China's economy seems to be doing worse than its stock market. I guess you could say that in some ways about the U.S. too, given the labor stuff that we've been talking about. But how are you feeling about this China TikTok deal that seems to be closer to coming to the finish line, and what that perhaps says about the prospects for cooperation internationally?
Yeah, it's funny. Where we're looking when we talk about China macro, global macro, and even trade talks, we look at dollar volatility. And right now, that's broken down. That's very, very low. So kind of piggybacking on what Barbara was saying here, low rate vol, which we're getting with the Fed cutting, lower dollar vol with a better kind of global trade setup, and lower oil vol, which is basically a symptom of kind of less geopolitical uncertainty. That's all good for buying risk assets, whether you're domestic or international. So to us, as long as those three things stay intact, you're buying risk assets in the US and globally. And that's probably why China tech's working so well too right now.